These last several weeks have seen absolutely incredible volatility in the stock markets. And all of us here at KC Research believe we are on the edge of an incredibly dangerous situation that will require drastic measures by investors in order to survive the damage that's coming. To this end, I've asked my good friend Ed D'Agostino to help moderate the discussion with our top analysts, including Doug Casey, Dominic Graziano, and Dan Steinhardt. Our team at the KC Report have been onto the signs of a major market correction for the last few months. It started with several important changes in many trends and technical indicators our team tracks. Many indicators of market momentum turned upside down in the first time in 5 years, and were spotted by our lead technical analyst, Dominic Graziano. He's the first in our series of interviews that will give you the complete picture of what's happening in the markets and explain how to best position yourself to sidestep the majority of the pain and come up with strategies to edge your portfolio.
Dominic's joining us from Tampa, Florida today. Dominic, welcome.
Good morning.
Dominic, tell me, what are the signals that you're seeing changing in the market now?
Well, we've seen breadth deteriorating since the spring in the markets. And in August, I wrote in the Casey report that the Russell 2000, which is the small cap sector of the market, tends to be more economically sensitive, was rolling over and underperforming the S&P 500, the larger cap stocks. Typically, the Russell 2000 leads on the way up and on the way down. The S&P 500 went on to make a new high in September. The Russell 2000 rolled over. And then in September, I also wrote about some of the longer term charts that we saw in the dollar and crude oil and copper. We've had long periods of consolidation in the monthly charts on the US dollar and crude oil and some other commodities. Typically when you see that, and it doesn't happen very often to have these almost 2, 3, 4 year periods of time where you've had a consolidation with deteriorating volatility. And then what happened in September is that volatility started to expand in the US dollar and the dollar started to move higher. Typically then you expect to see a much further move over the next few months, if not longer, in the whatever it is that's showing you that signal. We saw the similar thing in crude, but crude was breaking lower. On the crude oil chart, we had several months leading into years of declining volatility like we haven't seen in maybe 10, 15 years in crude oil, and now that's broken lower. So we would expect to have some more significant moves lower in crude oil and some other commodities. Then in October, this month, I also noted in the Casey report that we're seeing a significant breakdown in the S&P Goldman Sachs Commodity Index. Here again, we had several years of basically declining volatility, which has now, and a sideways movement in the index, which is now broken lower and volatility is breaking higher. That normally signals that we're going to have several months, if not longer, of declining prices in commodities and crude oil and probably lower prices in stocks as well.
So does the technical analysis that you're doing give you an indication of how low things could possibly go, stocks, commodities?
You can look at the charts to see where support will come in over the longer term and then set those up as targets and sort of as a stepping stone along the way. At this point, I think crude oil probably is going to test at least 75, maybe 70, maybe lower. It would be difficult to say for commodities in general. But for the industrial metals and crude oil, I think they have considerable ways to go lower. As for stocks, the S&P 500 recently broke through its 200-day. And more importantly, I put together a chart, 20-year chart of the S&P 500, and we tend to go through these 5.5-year cycles. We have now completed a 5.5-year cycle. We had one from 95 to 2000, 2002 to 2007, and then 2009 until now. The trend line on each of those charts broke along with some indicators, and we're now seeing the exact same thing in the current setup on the S&P 500. When that's happened in the past, I think most people who are watching this will remember we had significant drops in the markets. That is likely to happen again, but certainly it's not guaranteed. But these setups that we're seeing are fairly reliable and have a high probability of coming to pass.
And Dominic, how would you define significant?
Moves in the equity markets of 20 to 30% over the next year and maybe subsequent to that lower. we'll probably see continued lower prices in crude oil. I would think crude oil is probably going to at least test 70 to 75, may go much lower than that. And other commodities, industrial metals, are likely to go lower. We're likely to see the dollar significantly higher. When we had this move in the dollar, similar move 34 years ago, the dollar went up considerably in a short period of time, about 60%. Whether it'll happen this time, I don't know. But it looks like we're going to have continued strength in the dollar and putting pressure on commodities and stocks.
So this correction has only just begun.
It's only just begun. We've seen a fairly nice move down in the last few weeks, as most people who are watching the markets would know. And I think this is really just the beginning.
Wow. Well, thanks, Dominic. We appreciate your insights.
Thank you.
Now let's speak with Dan Steinhardt. Dan is the editor of the Casey Report, and he's joining us today from Southern Florida. Welcome, Dan.
Hi, Ed.
So, Dan, I know you've been warning readers of the Casey Report to batten down the hatches since August of this year, and your portfolio reflects that. You've taken some very well-timed speculations, but mainly you've put hedging strategies in place. So tell me, now that the volatility is here, what can I do to prepare? What can readers do to prepare and protect their portfolios?
Well, you need to prepare your portfolio for the most immediate risk. And right now, that's deflation. So the first thing you want to do, as soon as you finish watching this video, is to go prune your stock portfolio. You want to get rid of all your momentum stocks. You want to sell any growth stocks that aren't going to be able to grow in a deflationary period, which is most stocks. And at the end of the day, you want to have 4 to 5 of the very best of the best companies left, ones with near-term catalysts for going higher in the very short term. Second thing you want to do is raise cash. Cash is one of the only assets that performs well in a deflationary crisis. And not only that, cash is ammunition. If the crisis gets as bad as we're expecting it will, there's going to be some serious 2007, 2008 style bargains near the bottom of the market. You want to be able to buy when everyone else is selling, and having cash is the way to do that. Third thing you want to do is make sure you own plenty of gold. Deflation is very bad for banks, very bad for the financial system. This crisis could easily devolve into a systematic financial crisis. And if that happens, gold could be your only asset at the end of the day worth anything, because it's the only financial asset whose value, it doesn't depend on someone else keeping a promise to you.
So everything that you've just laid out, they're all deflationary strategies. Is that the big long-term risk for us, deflation?
It's not the long-term risk. Deflation won't be the end game. Deflation has never been the end game in all of history, because we know how central bankers respond to deflation. They respond with money printing. And in particular, the Fed has specifically told us that it will not tolerate deflation. So as soon as the Fed realizes what's happening, it's going to come back with QE4, QE5, QE6. It's going to print more money than it ever has in history. And I expect the officials at the Fed to look at the $3.5 trillion that they've created since 2008 and say, I guess we didn't create enough money. I guess Paul Krugman was right. And they could come back with $5 trillion stimulus program, a $10 trillion stimulus program. Who knows? But they're going to print more money than they ever have. And that will, the conversation will turn from deflation to inflation very quickly.
So the recent market volatility that we've had, Dan, is there a chance that this is just simply a healthy, normal correction in the stock market, and then things will stabilize from here?
There's always a chance. We can't know what's going to happen, but what we can do is play the odds. And if you study the history of periods like we've just experienced, where we've had a period of unprecedentedly low volatility, followed by a plunge of pretty much all a plunge in price of pretty much all asset classes, with the exceptions of bonds and to a lesser extent gold. History shows that that's a warning shot. Things are likely to get much worse from here. We're going to see a lot of volatility. There might be some fake recoveries where the stock market drops 3% in one day and recovers 2.5% the next day, like happened in 2007, 2008. But don't let that fake you out. We're headed for a deflationary crisis, and that's what you need to prepare for right now.
Great actionable advice. Dan Steinhardt, thank you very much.
Thank you, Ed.
And now I'll be joining Doug Casey by phone. Doug is joining us from Aspen, Colorado. Doug, how are you?
Good, Ed. Nice to talk to you.
Good to talk to you, as always. You've been saying for quite a while now that we really have been in one continuous financial crisis since 2008, and that basically we've been in the eye of the storm for the last couple of years. Where do you think we're at now?
Well, I think we actually entered the storm in 2007, and it's such a gigantic hurricane that the eye of the storm is much larger than I anticipated. But you know what they say, if you're going to make a prediction of what's going to happen, don't give the time, or give the time, but don't say what. But I'm increasingly confident that we're in the same position now that we were in 2007. And when we go back into the trailing edge of the hurricane, it's going to be catastrophic, much worse and much different than what happened in 2008 and 2009. And I think it's starting to happen now. So that's the way I see it. And there's no fundamental reason, as far as I'm concerned, to believe otherwise.
How do you see it being different than 07, 08?
Well, the big difference is that the government of the US has created about $4 trillion of new money by selling bonds to the Federal Reserve. So they've kind of shot that arrow. And that huge amount of currency has been created. It exists. The same thing has happened all over the world. The Chinese, the British, the European Union, the Japanese, they've all done the same thing. So trillions and trillions of dollars worth of currency units have been created worldwide. And they're basically just sitting in banks at this point, although some of it has filtered into the financial markets, creating a gigantic bond bubble and a gigantic stock market bubble. So that the governments of the world who foolishly did this have shot their arrow. And I expect that in the next few years, if we don't have a catastrophic deflation from people being unable to pay the new debts that have been taken on, we'll have a catastrophic inflation. So we're truly caught between Scylla and Charybdis at this point.
Doug Casey, chairman of Casey Research, thank you so much for your time.
My pleasure, Ed. Thank you.
We are issuing a special report detailing a set of actions all investors should undertake to protect their assets. I have instructed my team to send it for free to all of our paid subscribers, along with our cash book report, which has important tips on choosing the safest bank to store your money. Non-subscribers can order both reports by clicking on the link below. Finally, if you are a subscriber, you should pay particular attention to recent and future communications from our editors, as they have been instructed to close all positions that may not make it through this crisis. It is time to raise cash, no matter how little, and to have the tightest portfolio. We really think it will get a lot worse before it gets better. Thanks for joining us today.